Hi, everybody. It's nice to be here with all of you. My name is Yevgeny Shrago. I'm a policy counsel in Public Citizens Climate Program. I'm based in DC. My background is broadly in financial regulation. I worked as a federal government attorney at the Consumer Financial Protection Bureau. I also then worked in the General Counsel's Office of the Department of the Treasury during the Obama administration. And in particular, I worked as an attorney covering the Federal Insurance Office, which I'm going to talk to you a little bit about tonight. So I've done a bunch of different things and have been really excited to bring that work that I've done on financial regulation together with the work that you all and so many others are doing on climate in this role. And I am encouraged that so many people showed up, gave their Tuesday evening to come hear about insurance and climate risk. So thank you all for coming. Okay.
Thank you.
I'll take it away. Yeah, unless you wanted to say anything, Stephanie, before I get going.
No. The floor is all yours.
Thank you. All right. Well, I'm going to talk to you all a bit about insurance as promised. And in particular, I wanted to give you a little bit of a context about where we are. So in May, President Biden issued an executive order calling on the whole federal government to assess their climate-related financial risk. So when we say climate-related financial risk, we mean obviously the climate crisis is going to have tremendous impacts across the board, and that includes on financial institutions, banks, pension funds, insurance companies. And President Biden said that he wants all of the different parts of the government to look at both their own risk as well as the risk of the institutions that they oversee. In particular, that executive order directs an office probably you have not heard of before, the Federal Insurance Office, to do a report assessing both gaps in the oversight of insurers and challenges to availability and affordability of insurance. That report or that assessment is ongoing now. The Federal Insurance Office released a request for information in September, asking people all over the country to submit their perspective on some questions that they teed up. Public Citizen is writing a comment. We have another comment floating around for organizational sign-on. And we're also working on an activist comment. If you're on our Public Citizen climate list, you may have seen that comment fly through. At the end of the call, I will ask you all to think about whether you want to do have your organization sign on, if you want to personally sign on to the comment, and if you want to share it with others. I know a number of you talked about your own insurance experiences. We want to get those experiences shared with the Federal Insurance Office. And if you know others, we'll also ask you to pass that along to them, because it's really important to get your stories told. As a counterpoint to the insurers, we're going to come in and say that everything is great. So that's the broad context. I'm going to talk to you all a bit more about the specifics of insurance and how climate change is affecting insurers. I'm sure you can guess some details about how insurers are dealing with the climate crisis, some of the work that Public Citizen is doing to address that. Public Citizen and others in our coalition are doing to address that. And then I'll wrap up and we'll talk a little more about what you can do, and obviously leave lots of time for questions. Does that sound good? All right, I'll take silence as approval. All right, so the first thing to say is that this is a big deal. The Federal Insurance Office this is the first time that anyone in the federal government has talked about the way that climate change is going to affect insurers. And in particular, it's the first time that anyone in the federal government on the financial side has talked about how they can work with banks and insurers to actually reduce their support for the fossil fuel industry and for other high emitting industries. Our view is that's critical. So insurers basically make the world go around. I don't know I'm sure all of you have insurance or have dealt with insurers. I'm sure you know that you can't buy a house without insurance. You can't have a car without insurance. And it's the same in the business world. You can't run a major project without insurance. If you want to dig a coal mine, you need insurance. If you want to run a pipeline, you need insurance. If you want to have, you see the stories of spills, you see the stories of accidents. These companies, they can't cover that liability themselves. It's very risky. And so they buy insurance from major insurers. And that's the other thing, is they're not going to buy this from some small insurer. They pretty much exclusively want to buy these from the largest mega insurers. And that means, and without insurance, you can't get a bank to finance you. So that's actually not me saying that. That's the CEO of a major insurer, AXA, saying Without insurance, there is no financing. That's a direct quote in the Washington Post a few weeks ago. And we've actually seen that play out. A lot of campaigns have targeted insurer coverage of coal mines, and many insurers, particularly in Europe, have stopped insuring coal projects. And what we've seen is actually a major collapse in the ability of coal mines to get insurance and a subsequent reduction in coal mining. It's actually still a very profitable business to mine coal, but it's very, very hard to do because no one can get funding, because no one can get insurance. I mean, they can, but there's just a few large players left. Another example, one that a number of our allies are working on at Public Citizen, and maybe you know some folks who are working on this as well, is the Trans Mountain Pipeline, which is a pipeline from the tar sands in Alberta through the US, which would run a whole lot, or actually into British Columbia, sorry, that will run allow a whole bunch of additional tar sands extraction. That pipeline is running, but we have run a number of campaigns and gotten many, many insurers to agree that they will not insure the pipeline. The result is that that project is stalled and more expensive. The Trans Mountain CEO has said that they're paying more, and it costs them more to run the project, and it's caused delays because there is no insurance, or very little insurance for that project. So what you can see is that insurers really can make a big difference. If they stopped insuring fossil fuels entirely, fossil fuels would go away. We're not there yet, but we're making real progress. Another thing to keep in mind, and this is the thing that I don't have to tell this group, but it's just useful for framing the thinking about what insurers can do and why we should hold them accountable, is the point from the IPCC's sixth assessment report, the report that came out this August, that got a lot of attention, that every fraction of a degree counts. That the difference between 2.1 and 2.3 degrees of warming is pretty significant in terms of the kinds of harms we'll see. And the other thing to keep in mind from the sort of climate science we've heard in the last year is a strong consensus from climate scientists, from the International Energy Agency, from the UN, that the latest climate findings need to be a death knell for fossil fuels. That there's no room for new extraction or new fossil fuel projects. That if we just use up the fossil fuel reserves that are available today, we're going to burn up the planet's whole carbon budget. And anything new is just going to make things go beyond that. We won't hit climate-based science targets. So why does that matter? Well, the thing is, as you can imagine, climate change is really bad for insurers. So there's a lot of different kinds of insurers. And when I talk about insurers, I'm mostly going to talk today about what we call property and casualty insurers. So they write homeowners policies, they write policies for businesses, and they write policies for basically anything that can be destroyed by a natural disaster, except people. Those are life insurers. And when you think about them, they pay out more when there are more disasters. So climate change means that there are more disasters. 2020 had the most billion-dollar disasters in history, with 22. 2021 might not quite make it there. It's November. It was at 18 last time I checked. I don't think we've seen one since then, but still $33 billion in insured losses in the US already this year. To give you another example of just how damaging climate change is to insurers, the 2017 and 2018 California wildfire seasons, which were bad, but not as devastating as the most recent ones, they wiped out 25 years of insurance industry profits in California. So they spent 25 years pricing things out and thinking they were doing great. And in 2 wildfire seasons, all of that was gone. So insurers stand to seriously lose from the climate crisis. Yet they continue to allow fossil fuel production. So just to lay this out as I put out all the facts, every diffraction of a degree matters. If it gets a little warmer, there's more damage, more severe disasters, more frequent disasters. Insurers are harmed by these disasters. And yet when insurers underwrite fossil fuels, they actually make those disasters more likely. They're sowing the seeds for their own destruction. And the question gets asked, why do insurers continue to underwrite fossil fuels? It's a good question, but we think that there needs to be pressure on them to stop. Another thing to think about is that they actually invest in fossils. So insurers are not only property and not only write insurance policies, they take the money they get when you pay a premium and they invest it. They invest it in all kinds of things. They're some of the biggest investors in the world. And insurers consistently, whenever anyone does a study of insurer investments, they find that insurers consistently are over-invested in fossil fuels. That means if you build sort of a benchmark of what a market is, like the S&P 500, or any kind of like a way of comparing what a normal investment portfolio looks like compared to what a big insurer investment looks like, the big insurers are funding fossil fuels that way too. So they're allowing it from an underwriting perspective by writing policies. They're allowing it by pouring money into it. And it's bad for them. It's bad for them because it creates new and destructive disasters. It's bad for them because actually when insurers adopt coal and oil and gas exit policies, when they say they're going to stop underwriting fossil fuels, the European insurers who have done that have actually seen their stock prices go up. That's something that investment banks tell them, that there's a green premium from choosing to get out of fossil fuels. And still insurers do this. And you might have heard me say European insurers before. That's because the insurers who are really continuing to fuel the climate crisis, the ones who are the biggest writers of coal, and some of the biggest supporters of oil and gas, are American insurance companies. So Public Citizen is part of a coalition called the Insure Our Future Coalition. It's a group that which is a coalition of campaign groups that work to get most major American and through our global partnerships, global insurers to get out of fossil fuels. Every year they publish a scorecard of where insurers are on their coal, oil, and gas divestment policies and how aligned they are with Paris targets. Every year, the US has the 5 or 6 biggest laggards. So when you think about huge insurance companies that you hear about, AIG, Travelers, Allstate, these big insurance, State Farm, all these big insurance companies, they're at the bottom. The European insurers are ahead of them. Chinese insurers are ahead of them, also lagging, but the US insurers tend to be the worst insurers at doing this stuff. So it's clear, so we know the US insurers are the worst. We know that they are continuing to invest in fossil fuels and underwrite fossil fuels, even though it's bad for them, bad for their business in the short term, bad for their business in the long term. So it's pretty clear that there's a market failure going on here, right? Something is happening that means the private markets won't solve this. We hear a lot of, oh, this can be done. There are all these insurance alliances popping up, all these insurance companies saying they'll do it. But it's pretty clear if they haven't done it now, they're not going to do it of their own accord. So we need action by regulators. That's the first and most important thing. The problem, you all may know, is that the US's insurance regulation is not done at the federal level. There's very, very little insurance at the federal level. There's a federal law called the McCarran-Ferguson Act that says that insurance may not cover, that the federal government generally can't get involved in insurance. Instead, it's regulated at the state level. So what that means is every state oversees its own insurers. Every state sets its own rules. You all are in Texas. Don't have to tell you. A lot of states are still resisting the idea that climate change is something that is causing real harm, or that the climate change is something we need to take real action on. So there's a few states, but even the states that you might expect to act, very few are acting. The states that you expect to act, what they do is they administer a survey every year. They ask insurers to tell them, how are you doing? Here's some yes/no questions about what you're doing about climate change. It doesn't really give you much information. It was designed in 2009. We didn't know a lot about climate change back then, or we knew a lot less about climate change back then. They're in the process of updating it, but it's being tied up because they want to move with consensus. And some of the states that don't want to move so much are pushing it back. A few states are going it alone. New York has done some really good work. They're going to release some really interesting climate guidance next week that actually calls on insurers to start reducing their insuring and financing of emissions in order to manage risk. We think that's a huge victory. We're going to wave that around and call on every other state to join them. But that's one state, and we need all 50 states to pull in the same direction. There also is a little bit of federal regulation, but that federal regulation was pulled back after the Trump administration, during the Trump administration, and the Biden administration, unfortunately, has actually not wanted to move forward. So there's a body that can pull insurers into the federal banking regulatory system, which makes them subject to all kinds of oversight. But that body is currently dormant. It's not operating anymore. Well, that's really concerning because because climate change is hugely risky, insurers can take a lot of losses. And what we're worried about, one of our great fears of public citizen, one of the things that we really hope to impress on the Federal Insurance Office and on all the federal regulators is that this is a pathway to a new financial crisis. If you think about how risky subprime mortgages were in 2008 and the way banks were buying them up and the way insurers were covering them, and then when the music stopped and it all blew up, the same kinds of things are going to happen with fossil fuel assets when we need to do a green transition, or when climate disasters get bad enough that things fall apart in whole sectors of the economy if we don't mitigate climate change. So there's a real risk of a financial crisis, and the federal government is kind of sitting on its hands and not doing anything, dealing with underregulated insurers. So we're really vulnerable. I'm not here to tell you it's a good moment right now, but it is a moment that the Federal Insurance Office can take action on. So the Federal Insurance Office is not itself a regulator, but it's the voice of the Department of the Treasury. And it can, if it comes out and says, we think states need to do more to oversee the way insurers are taking on climate risk, the way insurers are investing in fossil fuels, we need the federal government to use the powers that it does have to its fullest extent. That's meaningful. That's going to get real action. It's not going to get 100% of the way there, but it's going to move things in the right direction. So our comment is calling on the Federal Insurance Office to do just that, to write a report laying out the gaps that I just told you about, and then make the recommendation that states and federal government do more. So when we're seeking sign-on from people to make that voice louder. The second thing we should talk about is availability and affordability of insurance. So I heard a lot of you mention this as we started our discussion. And the point to make is that it's a real problem. It's a problem around the country. So the place we can start is with flood insurance, as we mentioned. So there's a national flood insurance program. I think someone asked the difference between private and federal flood insurance. And the answer is that federal flood insurance exists in places that the Federal Emergency Management Agency, FEMA, designates as flood zones. In those flood zones, most people get flood insurance. They have to give it to you, and 96% of people get it because it's the only option or the most affordable option. Unfortunately, just because it's the most affordable option doesn't mean it's actually an affordable option. What we've seen over and over again is that premiums go up. They're right now capped at 8. They can only increase by 18% a year, but they have tended to go up fastest in poor communities that do not have, because those communities have the highest risk of flooding. Why? Because of environmental racism, because those communities have historically been located in flood zones because they didn't have the power to locate elsewhere. Because there's been disinvestment, because the tax base has been drained in a lot of communities of color and low-income communities, which means they haven't been able to invest in drainage, in flood mitigation, which puts them at a higher flood risk. So those rising prices now, in some places, this is true, it has been best documented in New York, but I'm sure it's not just true there, I'm sure it's true in Texas and other places, is actually starting to drive whole neighborhoods into foreclosure. Places where people have bought a home and have started to build some wealth, they can't afford their flood insurance premiums. And if you can't get flood insurance, you're in default on your mortgage, which means that the house is subject to foreclosure. So that's a big challenge. FEMA is doing some work right now to try to reset the premiums in a way that the higher income, higher wealth, more expensive houses that currently don't pay enough pay more of their fair share. But the premiums are already very high. And it's a very political process. So there's a lot of danger there. It's something that needs action now, and it needs more protection for low-income communities. Another thing to think about is wildfire. Another place where we're seeing this really manifest now is wildfires. In California, between 2018 and 2019, so remember I told you 2 years wiped out all the profits of the California property and casualty business. In 2019, they decided to deal with that problem. The way they dealt with it is they started kicking everyone who was in a high wildfire risk area off of their insurance policy and denying it, kicking them onto a state insurer of last resort plan. Those state plans are also very expensive. They don't cover very much. So people who get pushed into those plans are in real trouble. It got so bad that the California Department of Insurance actually had to put a freeze on non-renewal. That meant that insurers could not stop providing people insurance coverage in 2020 and in 2021 in high wildfire risk areas. But that doesn't mean that they can't raise prices. And although there's an overall cap, on how much insurers can raise prices in the state. They have a lot more flexibility on specific rates. And so you've seen people in high wildfire risk areas see pricing premium increases as much as 80% in 1 year. It becomes really unaffordable to live somewhere. And again, the things that drive down insurance premiums in those states, so you're rebuilding your house to post 2008 standards, investing in various kinds of other mitigation, actually cost a lot of money. And communities that have been disinvested in may not have access to credit, may not have the ability to, people who are already housing stressed may not have the ability to make the investments in their home. So again, you're just going to see people who are rich get richer, and people who don't have enough lose even what they have if this continues. The third thing is the thing that I think many of you are probably well aware of. It's something we see a lot in hurricane-stricken areas, which is just spikes in claims denials and slow claims processing. So we've documented this a lot in Louisiana, but I've heard many of you say it's true in Texas for hurricanes. I've also seen it's true for the winter storm you all had in February. Insurers will simply deny huge swaths of claims or drag their feet. And what does that mean? Again, what does that mean? That means that the communities cannot rebuild. It's a drag on economic growth, economic recovery. And it's particularly bad for communities that don't have access to credit because of long-term discriminatory credit policies, because our financial system is designed to serve those who already have money. So people who can't get a loan, or who are going to only be able to get a loan at a high price, they're going to be locked out of recovery. So in Lake Charles, Louisiana, something like 50% of claims still haven't been paid from Hurricane Laura in 2020. So that's a town that cannot rebuild because the money that they need to rebuild is locked away. So like I said, all of this is disproportionately falling on communities of color and low-income communities, or at least we suspect it is, because there has not been any large-scale study of the problem. So we call this is called blue lining. And the way, if you all have heard of redlining, which is the idea that it creates that certain areas have been denied credit. Well, because those areas have been disinvested, as we talked about in all these different ways, now insurers follow behind and say, well, just totally no direct racial lens, just thinking about the risks. These areas are very risky. They don't have the infrastructure. They don't have the protection that we need. So we're not going to write policies. We're going to raise prices. So they recreate the same sorts of things that redlining did in the 30s and just continue to draw a wealth out of those communities. Again, I've painted you a very bleak picture. So let me spend the last 5 minutes talking about something a little cheerier, which is the work that we've been doing to get insurers to divest. And there's a lot of work, and there's a lot of success. So Public Citizen is particularly deeply involved in the campaign to get AIG, one of the largest insurers, to exit from coal. We do all kinds of fun things. We have done actions outside of their headquarters. We've made fake job applications to send in, asking them about climate. We obviously do kind of more normal things like letter petition drives, and have had meetings with their chief sustainability officer. And it's getting there. It's a slow process, but we have seen, especially in Europe, many insurers start to divest. In Connecticut, there's a couple of big insurers, Travelers in the Hartford, that they're not doing great, but they've certainly made strides. Chubb is another big insurer that has made some strides on the coal policy. So we're continuing to do this work, but what will help, what we need, is more information about what the insurers are doing. Insurers will all tell you we are net zero. That's the new buzzword in business for climate. Net zero. We're net zero aligned. So that means that insurers will say, oh yeah, we're meeting Paris climate targets. They're not counting the fossil fuels, the emissions that they insure, or the emissions that they finance. They're just counting their office buildings and the fact that they stopped doing business travel. So what we need is better information about what they're actually emitting, so that we can hold them accountable. And there's a lot of work being done. So the Securities and Exchange Commission is about to write a climate risk disclosure rule that we expect will require big publicly traded insurers to tell us what their emissions are, including what their emissions are that they insure and underwrite. We think that there's a few states are going to start requiring that information as well. So we're getting a better picture. And what we're calling on FIO to do is to fill in the gaps. We want them to pull information from every insurer who's above a certain size about emissions, about fossil fuel investment and underwriting. And then we want them to every year basically publish a report that says these insurers are meeting or making progress toward their net zero targets, real net zero targets, not the branding ones, and these are falling behind. We think that that's something that will have a huge, huge effect on insurers, because insurers are companies. They're not necessarily evil. They don't care, and their evil is banal. I guess I'll say is that they're not evil. It's just that it's a very banal kind of thing. And if they're pressured and if they're embarrassed, they will get better. And so that's the kind of thing that we want to push them to do. So I've laid out a little bit. Our goals are to get the Federal Insurance Office to highlight the big screaming regulatory gaps. The way that states and the federal government, the people who actually have the power over insurers, are asleep at the switch, and make some recommendations about things they can do to fill those gaps. We're asking them to do a systematic look through on all of the different kinds of insurance that are being denied, where prices are being raised, where people are being denied coverage, where claims are being denied, to look at that and tie that to climate impacted areas, and so it's good to climate change, and lay out what is happening, where are insurers pulling back, and how is that particularly affecting communities of color, low-income communities, and other historically underserved groups. And finally, we're asking them to gather information about what insurers are doing to finance and underwrite emissions, to publish it, and to serve as a watchdog, to call them out for when they lie about and when they greenwash their actions. The way we're doing that, as I mentioned, is we're writing a long sort of technical comment laying these things out. We also have a shorter organizational sign-on comment. I can share that if there's interest, either here or later, where we're asking all kinds of organizations who have an interest here to sign on to join their voice to our request for this. And then the last thing we're doing is we're asking individuals, activists, to send their own comments to the Federal Insurance Office, to ask them again to ask them to do the same thing, and two, to tell their story. We have space in the comment to lay out your own sort of experience with insurance. That's a short one. If you want to tell a long story, we encourage you to submit an individual comment, and it's actually very straightforward. And I can help you if that's something you want to do. I can set you up with what you need to do. So that's what we're doing. And the last thing you can do is, if you're interested in this, and I'll pause for questions after this. If you're interested in doing more of this work long term, the Insurer Future Coalition, which is how Stephanie linked in the chat, is always looking for new people to work with. I think we did do an action in Texas. Liberty Mutual, I believe, had a shareholder meeting in Texas, so we did work there. So it's a chance to come after insurers on their home turf. And there's always work to do. And I think we're making a lot of progress. We've raised visibility of this issue a lot. We've pushed back on insurers, and they are grudgingly doing things that they need to do. So I think that this is a great opportunity and a powerful lever that is not nearly paid attention to enough. So that's my chat. Thank you all for listening. I'm happy to take questions. I see there's one in the chat already. Would carbon capture, hydrogen, offshore wind be covered? Can you say more about what you mean by that question?
Sure. So I'm saying you described a framework where you don't want to insure some projects because of their fossil fuel connections. So would you consider carbon capture a fossil fuel project that you wouldn't want to insure? There are different kinds of hydrogen, some good because they have electricity generated by renewables, but they're still doing processing the same way. And then offshore wind, there's good, and then there's environmental issues with the moorings and other things that they may be doing to do that. And would you consider that insurable or uninsurable with the parameters that you want to use?
Sure. So I would have to look at the specifics of any given project. The broader view is this framework is that what insurers should be doing is they should be transitioning their business to alignment with science-based targets. So the Paris-based climate targets and the US's climate commitments under those targets. So to the extent that a carbon capture project is a lot of carbon capture is fake or notional. And that would not be something that insurance companies should be engaged in. To the extent that those carbon capture projects are often having really negative effects on communities of color, especially, because of where they're sited. We wouldn't want insurers to cover that. But I think from a
Okay,
purely
so
carbon,
I'll
sorry, let
give
me,
you a specific one. In
yeah,
Houston, they want to
yeah.
do one that's going to go, they're going to store it offshore. So would you consider, if it's onshore, you wouldn't consider it, but if it's offshore, you would?
I think I don't know enough about the project to say specifically. I guess what I would come back to is just assessing how it aligns with science-based targets, whether it actually is going to reduce emissions or whether it's just going to kind of enable more emissions to be made while claiming that it's reducing emissions. I think Stephanie probably is the expert on this particular project, right? So I would defer to her.
Right.
Similarly with hydrogen, right? I think there are some forms of hydrogen that probably are aligned with science-based targets. So green hydrogen, and I'm not by no means an expert on hydrogen. I suspect the green hydrogen projects would probably be fine. Brown hydrogen would be not. And then with blue hydrogen, you might have to think about sort of where you are in the transition curve. And offshore wind, same thing. I think under this particular framework, we probably wouldn't say no to offshore wind because it is aligned with science, with sort of climate targets. But there are other considerations, right? It's not just about climate; it's about making sure that things are happening in a way that's respectful of justice considerations, respectful of the environment as well. So, like, those are other things that are not directly sort of in our call, but things that other groups that we work with would probably be able to tell you more about, particularly.
Thank you.
Yeah. I'm happy to just go down the list of
Hello.
questions, but Stephanie, do you have a different preference for how to do this?
Hello.
I think there's someone trying to ask a question
Yes, my
now.
name.
So let's
Yes,
take
Dolores
Miss
Magruder.
Magruder and then go down the list.
All right, go ahead.
My name is Dolores Magruder. I live in a low-income community. Well, mostly if you talk to my neighbors and the people that live here, they probably wouldn't understand hardly anything that you talked about. But what I wanted to say is, why are we still living in the 20th century when it's the 21st century? Why can't we come up with new innovative ideas? Maybe we need to reach out to the masses and maybe ask them, what can we do to help our country? There's 330 million people in this country, and people is trying to tell me only the people in Washington, D.C., the ones that run all these, companies of the, this country, they're the only smart person that can come up with ideas. I think it's time for us to ask the masses to join the fight. This climate change is going to affect us all. And yeah, you know what? They petty because they want to keep all the money in their pockets and don't want to share anything with us. Since we already know this, we need to demand, not ask anymore, but demand. We want to be a part of this country. It's our responsibility as well as our God-given right to make decisions for ourselves. No, thank you. I don't need no handout. I'm not looking for one. I want to be a part of the decision making. Just like me, I had a vision about that cars could be on a magnetic field underneath the freeways we already have, and it would be magnetic ties that would lock on to the magnetic fields. We could do this. That would cut carbon emission greatly. And matter of fact, it would do so many things. All this road rage on the freeway, police chases, distracting driving. We can go on, and we would not have to do anything. Just reinvent our freeways, and get all these smart scientists that come up to invent the magnetic wheel. And how it would work? As long as you're on a freeway, the wheels would be magnetic. But as soon as you get off the freeway, they would turn back to rubber or some other substance. Now, I know we can do this together because these people is not in our corner. They're not thinking about us. They go home to their families and they have a great time, maybe, because just because you have a whole lot of money don't mean you happy. But we don't need to be like the foot stove of all these people that have so much money that they don't want to share. It's time for us to speak up. Instead of us grand rushing, the capital, it's time for us all pull together in this country and, get our rightful share. Because everybody, the United States of American Constitution say that everybody can pursue happiness. And I think everybody wants to do that, sir. So thank you.
Thank you.
Yeah, and Miss Magruder, sometime we'll have to talk because I know some people working on projects like what you're describing. So we have to talk some more about that later.
So Ed has a
Thank you.
good, thank you. Ed has an interesting question in the chat here about insurance companies using statistical modeling heavily, but do they accept climate modeling when underwriting? They do it many do not, and the ones that do, it's not necessarily great. So a lot of the issue is that climate modeling is very long term. And aside from maybe life insurers, most property and casualty insurers underwrite sort of 1-year contracts. So when they look at a 1-year deal, the climate risk is not really there. Part of their climate model, they're just sort of saying, okay, they use historical experience, which is really dangerous because as we've seen a lot, past the past the future no longer looks like the past with the effects of climate change. So this is a big part of the risk. We talk about this a little in our technical comment, that insurers should not just be relying on old historical models because it's too dangerous. And to the extent that they do, of course, the models are very, like climate modeling today is not super precise. You can say there's going to be a slightly elevated risk of hurricanes, but you can't really place hurricanes. And so it creates some challenges there as well. So even when they do rely on it, if they're doing it in the sort of the classic insurer way of, let me like really optimize my model to get risk, to figure out risk, it often can put them in a position where they think they're really smart until it all comes crashing down. So this is very similar to the 2008 financial crisis, where insurers thought they knew how housing markets would work, and it turned out they were terribly wrong. And AIG helped pull the whole economy down. Herman, do you have a direct follow-up on that one?
Yeah, I'm working with HARC, the Houston Advanced Research Group here in town, and they've come up with some consulting services where they are doing 5, 10, and 15-year risk, climate risk consulting services for power plants and transmission units, where they're doing statistical analysis in the future and doing probability analysis on it. And we haven't gotten our first sale yet, but we're getting close to it. So
nice. Yeah, it's very important to get better models in the market. The next question I have from Jimmy is, why is the market not working in terms of insurer portfolio risk reward? Is insurance overall underpriced, or are non-climate risk areas subsidizing climate risk areas? So there's a couple things. In terms of why insurers are not getting out of fossil fuels faster, I think to some extent there is an issue of just long-term lock-in. So, insurers have done business in a certain way. They don't want to make major changes. And so they have a tendency to continue doing what they've always done. In particular, I think sometimes some insurers may be concerned about running afoul of some state regulators. I know we've seen that just from what I've heard about the work that the Public Citizen does in Texas. Sometimes when municipalities want to get ahead of the state has a nasty habit of snapping back at them. And so insurers may be hearing that. Fossil fuel companies continue to have a lot of political power. Insurers may not want to get crosswise of them. So that's one of the reasons why we think it's really important to generate pressure to create some countervailing force there. And some of it is just cultural. So there's a great story in the American Prospect by someone named Alex Salmon a couple of months ago, where he talks about somebody at Liberty Mutual kind of figuring out what I talked to you all at the beginning about in the 90s, about how insurance is going to blow up under climate change, and him started getting really encouraged to start a sustainability group and, greening the facilities. And then when he started saying, hey, why are we underwriting fossil fuels? He discovered he was very quickly frozen. So there's just, I think, a cultural issue that people in insurance company leadership don't see. In terms of whether insurance overall is underpriced, I think it's an interesting question, and there's some level of cross-subsidization. So state laws generally say that one insurance line is not allowed to cross-subsidize another. So you have to write your risk for a so if you say do property and casualty insurance, you do life insurance, you can't raise your life insurance prices in order to make your homeowner because your homeowners is losing money. I mean, I'm sure some of that still happens, but it's a little less than less than you'd expect. So that shouldn't be happening. And it might be a little underpriced in some places because there are caps on how much insurers can raise prices, and two, for political reasons, sometimes insurers will keep those prices low. But also that they tend to keep them lower in sort of rich communities. In the flood insurance program, this is a serious problem. Rich areas are way underpaying for their climate risk compared to poorer areas, and it's something that is a huge political hot potato. And people keep building new houses on the coast that they can't afford and shouldn't be covered. So that's a challenge. But it's also an area that just is really understudied. And it's one of the things we want FIO to do is to better understand what's going on. Why are these insurers raising prices here but not there? And how are they making their money back on people? So it's a question that needs a better answer than unfortunately we have today. Do 10K reports breakdown. So let me go to Ed's question and I'll handle Jimmy's. We've seen a lot of mismanagement of federal money for disaster mitigation. Private insurers drag their feet or cancel it in convenient times. What can homeowners do to protect their homes in high-risk areas like Houston? Unfortunately, I don't have a lot of answers. I more know about insurance regulation and less about sort of the specifics of that. So I cannot answer that question. I will have to punt. And then the question on do 10K reports break down returns by business category? Yes, but the answer is yes, but often at a very high level, and it depends on the insurer how fine-grained they get. So that information is usually helpful at a very high level, and usually they'll tell you sort of by their line of business, but not more closely. So like I can't tell you how much insurers get from fossil fuel companies, for instance. No insurer reports that, but we are pushing to get that information disclosed.
Yevgeny, would you just mind really quickly explaining what a 10K report is?
Yes,
for
sorry.
Not know?
Yes, my apologies. I took it out of a 10K. So according to US securities law, every company is required to file an annual report for their shareholders that provides sort of the most important information about the company. And what the company discloses, there are a lot of rules, very technical rules about what the companies have to disclose. And in particular, they have to provide financials, and those financials have to be audited by a large auditing firm so that they are sort of certified as trustworthy. Right now, most insurers don't really provide any climate related information. So they don't tell you, or most companies don't tell you how much they're emitting, how much whatever their risks are from climate change in terms of, are they in a hurricane zone? Are they potentially going to have a big problem if fossil fuel prices collapse? They don't have to discuss that right now. There's work being done right now at the Securities and Exchange Commission to actually make it add a bunch of climate related information. We may come back to you all with some requests around doing some activist comments on that as well. But that's probably coming early next year. So for right now, there's a real lack of information about what insurers are doing and other big companies are doing around climate change.
I'll push back a little bit on that, because on the 10Ks, they actually do disclose some of what their perceived exposure to environmental risks and the laws associated that they could be hurt by. It's not as bad as you have just painted it. There is stuff that is in by the SEC and FASB that are forcing people to do things that they didn't have to do before.
So that is a fair point. I will say that the sort of risks that you're talking about tend to be the sort of material risks tend to be a very boilerplate recitation. So they'll say something could happen with a very little sort of detail. And yes, it's true, the SEC and FASB are doing more. And FASB is a accounting regulator that sets some standards for how companies are supposed to report and what risks are and how others are supposed to report them. Do I know if Ceres or Climate Action 100% are looking at insurance companies? The answer is yes. Ceres is also writing a comment. Ceres does a lot of work on insurance matters. And Climate Action 100, I think, also is very engaged with insurers. the ones who are publicly traded. In terms of the sign-on, like I said, there's two things, and I can drop the links in the chat if that is useful.
Yeah, that'll be great. Thank you.
So two things. One is if you work at an organization that signs on to sign-on comments, we would love, turns out I can't do that. We would love to have you sign on to our coalition comment. So that's a comment that basically we're getting a large number of groups. We're hoping to get as many groups as possible from as wide of a range of backgrounds as possible to sign on. And basically what that does is it's what I just, it captures what I just told you and makes a set of recommendations. And I didn't get into the details because they're specifics to the power, but essentially to do some studies, do some reports, and to do some calling out, not because we don't want to do more, but because that's all that this office has the power to do. The second thing is if you and the deadline for that is this Friday. So that's pretty soon. So if your organization can't do that, or you're not an organization that signs on to things, then the other thing we could ask you to do is to personally send a comment, basically a comment to the Federal Insurance Office, asking them to take a serious look at what insurers are doing to provide information about insurers to the public. And then also, we do think it's really important for people to share their own stories. If you've had problems with insurance prices going up, with claims not being paid on time, insurers are going to come in and they're going to say, everything is hunky-dory. We've got the climate change covered. We're doing really well. Here are all of our great programs that we're engaged in. Here's how we're getting to net zero. We're not going to emit anything by 2050. And we want to make sure that the full story is being told. Eventually, I think my expectation is that there will be a report written based on all of these comments, and then some next steps taken, some additional data collection. And so we really want to make sure that the full story is being told, and not just the story that insurers want to tell. And individuals coming out and saying, "Hey, I have this challenge. I've had this challenge," will really help, sort of lay the groundwork for the need to do a more systematic study to really say how many people, if millions of Americans are affected by climate change and are struggling to get insurance, then there really might need to be a federal law or state laws to help them out. And if there's not a specific, if there's not enough, the more numbers and the more data we have, the better chance we have of actually running campaigns to get these kinds of actions taken. So we want the government to do that work because it's best positioned to do it. So that's where I'm at. I don't think anyone is looking at FEMA malfeasance, but I don't know if that's something happening in Texas. I don't know everything that people do.
Yeah, we're not really doing that in Texas, but I think there are other organizations that are looking at that.
Cool. All right. Other questions? 4 more minutes. I don't know how late we go. Maybe 34 more minutes.
No.
Hello, this is Miss Magruder.
Yes,
One more
hi.
time. And yes, your presentation is great. But with me, it's about the insurance companies that come into my neighborhood and discriminate against us. Like I can tell you a little short story. My house was damaged by a hurricane. They sent one housing inspector. He actually said the only damage I had was $6,000. And I was really happy with that because I really hadn't seen $6,000 at one time. But then I waited for a week because he said a week, the company would be getting in touch with me. Okay, after that week passed and I didn't hear from anybody, I called the company myself, the insurance company. And the insurance company instantly say, disregard that inspection report. We sent another housing inspector. The other housing inspector came out. He said my house was totally couldn't be repaired. He said, I'm going to send you a check for $23,000. Now the difference between $6,000 and $23,000, that made all the world difference for me. Not to only just fixed up my house, but believe it or not, almost with that payment got a brand new home. So I don't know why, they come out here, claim they to be insurance, companies, but they take advantage of the low income, weak, as they look at us, peoples. And that should be put and need to be known how they come out here and discriminate against us. We don't have anything anyway. But yet they come out there with high prices. We make a claim, they double the insurance. So you're afraid to even use the insurance once you receive insurance out here, unless it is a big disaster. So I wish you would put that, to somebody's attention, because that should not be done to you just because, you low income. We don't have nothing anyway, sir. But it should be brought forward to let people know how they treat low income people in low income areas. Thank you.
Thank you. Absolutely.
Well, I want to say thank you so much, Yevgeny, for joining us this evening. I know it's an hour later where you are, plus with the time change, so it must feel like it's almost midnight in DC, but
I work in a basement, so I don't really see the light most of the day anyway. It's all the same to me. Thank you.
Well, yeah, thank you so much for joining us. And we are going to continue on with the meeting, but Yevgeny, you are dismissed.
Thank you. It was great meeting you all, and I hope you all have a chance to take a look at the materials I dropped in the chat and participate. And if you need any help, Stephanie has my contact. So please don't hesitate to reach out. Thank you all.
Thank you.
Thank you. Bye.
Thank you. Have a good night.